The risk disclosures appearing on the screen are important for you to read and understand. Please pause the video now to read through the disclosures or listen in as the disclosures are read aloud at the conclusion of this video.
So seasonals. Here's the definition. An annual pattern of changing conditions causing a well-defined annual pattern of price responses. So basically you have a cause, which is a change in events, and your effect is price response. I've got 3 examples for you. The first one's the cattle market. Typically, in early May, you would see a rally in the cattle market. Why is this? Because retail grocery outlets are starting to stock up their beef inventory for the upcoming Memorial Day holiday and summer barbecue season kicking off. The next shot is of a refinery, and what I want to discuss here is heating oil. We're coming up on July. July is typically one of the hottest months of the year. What happens then with heating oil? Heating oil demand subsides, and typically so do prices. They decline. And my last one here is, this is actually a shot of the Chicago Fed, which was right across the street from the Board of Trade, if anyone saw it. But I want to talk about bond prices. Bond prices seasonally decline into April and May because the market is anticipating tighter monetary liquidity. And why is that? What's happening in April or May? Taxes, right? We're paying our taxes, hopefully capital gains taxes. A couple other notes on seasonals. They're designed to anticipate future price movement rather than constantly react to news, which at times could be contradictory, right? You can be reading 2 different sources, and they may be telling you 2 different things, paralysis through analysis. Or you may get these 2 different reports and don't know what to make of the numbers. But the seasonals and seasonal spreads are designed to anticipate those movements. And seasonals are established tendencies. You know, consumers and producers, they tend to rely on these seasonals. At some points, actually become dependent on it, and they become fundamental conditions themselves.
Past performance is not necessarily indicative of future performance. The risk of loss in trading futures contracts or commodity options can be substantial, and therefore investors should understand the risks involved in taking leveraged positions and must assume responsibility for the risk associated with such investments and for their results. You should carefully consider whether such trading is suitable for you in light of your circumstances and financial resources. You should read the risk disclosure accessed at www.danielstrading.com. Daniels Trading is not affiliated with, nor does it endorse any trading system, newsletter, or similar service. Daniels Trading does not guarantee or verify any performance claims made by such systems or services. The risk of loss in trading commodity futures and options contracts can be substantial. There is a high degree of leverage in futures trading because of small margin requirements. This leverage can work against you as well as for you and can lead to large losses as well as large gains. Strategies using combinations of positions, such as spread and straddle positions, may be as risky as taking a simple long or short position. Examples of historic price moves or extreme market conditions are not meant to imply that such moves or conditions are common occurrences or are likely to occur.